market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for our very own Francine Lacqua. Top officials from Washington and Moscow, including U.S. Secretary of State Marco Rubio, as well as the Russian Foreign Minister Sergei Lavrov, are meeting in Saudi Arabia as we speak to discuss ending the war in Ukraine. That being said, while any representatives from Kyiv present. Now, French President Emmanuel Macron, in the meantime, has hosted fellow European leaders in Paris yesterday to discuss the EU's defense capacity as well as their solution to the end of the war. Now, the leaders did, however, find some common ground.
There was agreement and unanimity that a significant increase in defense spending is absolutely necessary, and there is no need to get irritated if an American ally says, spend more, be stronger, and more resilient, because those words are definitely justified by facts.
A series of European leaders speaking there. And that, of course, is happening as we talk about those top officials in Washington and Moscow. Like we said, we're speaking Marco Rubio meet with his counterpart Sergei Lavrov in Saudi Arabia at the moment. This is all coming as the time when you are starting to see European leaders across the board really scramble for some sort of direction. Let's bring in our Brussels bureau chief, Kevin Whitelaw, who, of course, is keeping up with all the news. Kevin, this is fascinating. We were talking just 24 hours ago about this divergence in terms of the European strategy and the American strategy. Let's start with these talks in Saudi Arabia. What do we hope to achieve out of the negotiations happening right now in Riyadh?
Well, you know, I think part of where Europe is so nervous is they don't really understand for sure what the Trump administration is hoping to achieve. There's a bit of a concern that the Trump administration is going to move faster than anyone is comfortable with to try to offer concessions with Putin aimed at ending the fighting. Up to now, so far, the Trump side has said this is preliminary, we're just exploratory, we're trying to understand where they are and where the flexibility is. And to be clear, it's not at all obvious that Putin is necessarily going to want to make. But at the same time, Europe doesn't have a ton of visibility into what's going on, and they have already watched as the United States under Trump has thrown out several different concessions, no NATO membership for Ukraine, and also just called into question sort of longstanding commitments that the U.S. has made to European security overall. So I think there's just a lot of nervousness as Europe is still just trying to catch up with events and figure out like what, if anything, it can do to try to influence things.
I think you said that key word there, their key phrase, I should say there, Kevin. If they can do anything, if there's anything to be done, there's a conversation happening right now, specifically in Germany ahead of the German election, where there is quite a bit of far-right support, or at least growing support for the far right that is looking for some sort of rehabilitation with Russia. Should Europe be viewing this meeting between the United States and Russia, the first since the onset of the war in Ukraine, as an early indicator that that's where the global economy is headed?
I mean, I wouldn't go that far. I do think that in this case, Trump is trying to figure out a way to deliver on a campaign promise that he made, which was to end the war in Ukraine. That was part of his campaign. It is part of what he wants to be able to do. He wants to be able to claim that, and he wants to be able to move on. As to exactly what that means down the line, whether that means some kind of rapprochement with between the U.S. and Russia, whether that means something else, we don't really know. I mean, Trump has floated the idea of getting a big slice of Ukraine's mineral wealth, for example, as part of a sort of in return for protection or whatever you want to, however you want to look at that. So I think we need to be careful in assuming that there's necessarily some grand strategy here, but there are definitely tactics at play, and those tactics could have the ultimate effect of leaving Europe a little on the sidelines as the U.S. and Russia find a way to put some of the differences behind them.
Certainly something we're going to be keeping a very, very close eye on. Kevin Whitelaw, our Brussels bureau chief, quite literally drinking out of a fire hose of news. We thank you so much. Of course, the markets are very much reacting on this story. We're seeing this in European equities. We're certainly seeing it in the defense sector. Let's bring in an expert who's been monitoring all of it. Hugh Gimber, global market strategist over at JP Morgan Asset Management, joins me around the table. We keep calling this the peace dividend. The rally is coming despite depressed valuations. A tariff risk is still looming. Has Ukraine, or a potential peace deal in Ukraine, whatever that looks like, taken the place of tariff worries out of the States?
It's not taken the place, but at least it's taken some of the focus back off, because when you start to look about the European outlook now, you can think about the positives to come from a potential peace deal, offsetting some of the negatives that I still think we have ahead coming from tariffs over the next couple of months. But when you break down how this impacts the European economy, there are a few different channels that you're looking at. First of all, confidence. Obviously, consumers, we know, have been very, very lacking in confidence over the past couple of years, therefore very reluctant to spend. If you get closer towards some sort of resolution, I think there's the potential for that to improve. Then you think about energy prices. This, for me, is still the biggest doubt. Would a resolution between Russia and Ukraine lead to greater flow of energy back into the European Union? Could that help to take energy prices down? There I'm more sceptical, frankly, that Europe would be willing to buy Russian gas. But then you come to defence, and the reason defence is rallying so hard is because regardless of how these negotiations go, Europe knows that it needs to spend more. And I think we're seeing the classic example here of Europe working best during a crisis. It's taken this new discussion between the US and Russia to finally get European policymakers moving.
You mentioned that key piece, which is energy, and I think that's really crucial here because that is one of the conversations happening ahead of the German election. And yet, when you look at it from a market's perspective, I'm waiting for that deja vu moment from 2021 or 2022, where the news coming out of the war in Ukraine, or even the war in Gaza as well, or even the supply chain concerns that come off of it, show up in the energy prices. And we're not seeing that. We're not seeing it in oil. We're not seeing it in nat gas. Where does commodities play a place in a portfolio right now?
Yeah, I mean, the commodity link for Europe is key here. When you think back to 2022, when we were first studying how the breakout of war in Ukraine was going to impact the global economy, the natural gas angle was really the clear transmission mechanism. And I think that's where Europe's been held back so far. You've had gas prices coming down a long way, but still roughly 4 times higher than the gas prices that US counterparts are paying. So there's a structural loss of competition for European markets. The discussion around commodities in the portfolio, I think, is quite different. This is more about some of the broader inflation themes that we're seeing, some of the tightness in labour markets around the world that we're seeing, and the need for diversification away from purely just bonds. And so commodities do have a role, but I think about that quite differently to the way in which they're impacting the European economy, where, as you say, we're seeing little reaction so far, I suspect, because the idea that Europe's going to be quickly back at the table to be buying large amounts of Russian gas is still a long, long way down the line.
Is that export picture out of the United States something that should actively be factored in? I'm immediately thinking of the LNG story that you sort of referenced there. But there's another viewpoint to this, which is that if Donald Trump is looking at shifting trade deficits, basically, what does that do to things like foreign direct investment? And is that something the market should be trading off of?
I think this is going to be the first area we see Europe making offers, frankly, when you start to understand more about how the US sees their reciprocal tariff plan in the context of Europe. The easiest way for Europe to respond is to say, right, well, you'd like us to buy more US goods, we need more gas, and therefore let's build a commitment there to buy more of what has already been flowing very steadily across the Atlantic. Take a step back. Europe has made incredible progress over the past 3 years. You know, we were sat here in Feb 2022 talking about Europe just having lost 40% of its gas flow pretty much overnight. And yet here we are 3 years on, that's all been found from elsewhere, whether it's LNG from the US, whether it's flowing from Qatar and North Africa. So there's been a big shake-up in supply. I think we'll be back in tariff land in a couple of months' time with the Europeans very, very keen to commit to larger purchases of US gas because they know they would rather take it across the Atlantic than coming directly from Russia.
So Europe at the whim of the United States. Sharon Bell over at Goldman was joining us in the last hour, had made the point that 70 to 80% of European defense spend leaks to the United States. So certainly a theme that's already existing. Does that also then throw some of the spotlight out of China? It almost feels like the bull case for China and Europe are quite similar in that you're looking at fiscal spend from leaders in the respective regions, but then you're also looking at these depressed valuations. Are China and Europe on the same page?
So they are purely when it comes to valuations, and you're scanning the world thinking about where the discount to the US looks most attractive. I think what's changing in China is less about the fiscal stimulus at the moment. It's more about the policy support, because that's the angle that's been lacking over the past few months. Go back to the end of September, you had big monetary and fiscal announcements in China in just the same week, lacking on detail, crucially, on fiscal policy. But you think forward to how that story has evolved, and now what we're hearing from Xi Jinping is greater support for the technology sector. Hints that tech clampdown might now be easing, and therefore encouragement for Chinese businesses to expand both domestically and overseas, which is a very, very different tone to what we've heard from Beijing over the past few years. So valuation-wise, yes, absolutely, both are trading on close to record discounts relative to the US. The catalyst in Europe, I think, does come from fiscal. In China, it's much more about what they're saying rather than really what they're doing on fiscal that I think would move the needle in terms of getting investors back.
Yeah, a fascinating one, both where sustainability of that is very much a good question. We did a whole tour around the world. We didn't even hit the UK yet. So Hugh Gimber, global market strategist at JP Morgan Asset Management, is going to stay with us to do that in just a moment. Before we go, though, I want to talk a little bit about that China story, because we are getting earnings coming out of Baidu. Their fourth quarter revenue coming in lighter than expected. This is really important here, because this is a company that's already been facing quite a bit of challenges when it comes to their internet search and, of course, their AI businesses as well. The shares in the pre-market over in the States, the ADRs there trading lower by about 3.4%. Of course, you are seeing the rhetoric that they're confident that this is a temporary blip, but the market's perhaps not believing them off of that revenue miss. So that's certainly a stock that we're going to keep our eye on. Coming up on the program, as promised, Hugh is staying with us. We're going to get the latest on the UK economy. The jobs data coming in 2 hours ago. The market still kind of digesting it. Marshall moves in the pound off the bat. Coming up, that conversation next. This is Bloomberg. Positive numbers coming out of the UK. Pay growth ticking to its highest level in 8 months. Unemployment, however, unexpectedly rising as the jobs market appears resilient to the government's upcoming £26 billion increase in payroll taxes. The pound off the back of it, 126.09 is where we're looking. For more, let's bring in Bloomberg's chief UK economist, Dan Hansen. Of course, Hugh Gimber has stayed with us from JP Morgan Asset Management as well. Dan, I'm going to come to you first. Your immediate reaction on these numbers?
A little bit surprising, I think, just on the quantity side of the labour market. Everyone expected a pick-up in wage growth today, including the bank. In fact, if you look at the private sector numbers, they were a touch weaker, but we're talking about a rounding error compared to their forecast. So I think there's a really interesting question now for the Bank of England about, has the labour market's period of loosening, is it coming to an end? Is the labour market sort of bottoming out? We don't think it is, but if you took today's numbers sort of at face value, I think you could make a not a particularly strong argument, but you could make an argument to say, look, the labour market loosening and the sort of reaction to the budget, that sort of reaction from firms has potentially run its course. I don't think it has. I think we've got a run up till April, and you mentioned there the national insurance hike, which is the key thing for employers going forward. But I think taking today's data as a whole, is it going to change the Bank of England's narrative? I don't think so. They're on this cautious cutting cycle, and the data today isn't going to change that. Slightly looser labour market, pay growth still very strong and above levels that they're comfortable with in terms of returning inflation to target.
Come in on that, Hugh. I mean, your reaction. How much of that sentiment do you share?
So, private sector wage growth, three-month annualized, is 7.6%. So, as Dan says, we knew it was going to be strong, but just put that into context. The Bank of England does not have a dual mandate. Its mandate is to control inflation, 2% inflation. And as Dan says, 7.6% is miles away from where the Bank of England would be comfortable in terms of looking at wage growth consistent with 2%. So for me, this morning's data raises a really interesting question, which is that if the bank hadn't told us they were planning to cut in February, why should they cut in February? ultimately, you've got inflation still running well above target. Yes, you've got payroll growth softening, but businesses are telling us at the same time that they plan to pull back on workers, they're also intending to pass through a lot of the additional costs from the national insurance hike directly to consumers.
Yeah.
And therefore, this, for me, sets the tone where if you're thinking about the bank in the context of gradual and cautious, which are their two new words, cautious is where they should be focused, because I think there's more work to do to anchor inflation expectations at this point.
So where does that position then UK assets relative to, say, what you're seeing in Europe? Because in the last year or so, I want to say since Keir Starmer, correct me if I'm wrong, Dan, since Keir Starmer really took power, you do start to see this idea that the UK is this island of stability, and you've seen it in every single asset. Does that argument that you've just laid out change the game relative to, say, European sovereign debt?
So politically, I agree with that stability, but economically, I think it's a different story. When you look at what's priced for the different central banks, for the Bank of England today, you've got 50 to 60 basis points of cuts priced for the remainder of the year. For the ECB, you've got 3 cuts priced. I think the ECB gets there under cruise control, right? Nothing that we're hearing in terms of more defence spending should prevent the ECB from cutting back to 2%. And I think if you get the tariff hit, they can go further. In my view, it's going to be much more difficult for the bank to keep pace with what's priced because, yes, they're still guiding towards this quarterly cadence. But ultimately, look at the data. The justification for them cutting further here is getting harder and harder to make. So in that context, we like European duration a lot more. I think there's a lot more asymmetry when it comes to German bond yields and some of the periphery as well than when you look at the gilt market, where I think it's going to be difficult to keep pace with Bank of England pricing.
Dan, we've got UK CPI tomorrow. Mm-hmm. Walk us through your view. What are you expecting there?
So we're the same as the bank, so 2.8%. There'll be a few one-off factors, so education prices, private sector school fees. If you've got kids in private schools, you'll know that that's gone up. So that's going to affect the numbers. A bit on fuel and a bit on airfares as well. So all stuff that is either well-known or volatile. I think going to Hugh's point, and he's absolutely right about the inflation picture in the UK, and I think the story from the past 2 years, particularly for the Bank of England, and the lesson is that inflation expectations probably aren't as well anchored as they would like. And the big judgment they made in their forecast is that this upcoming bout of inflation that we're going to get, so we're going to get inflation of above 3% this year, is that it's going to be a sort of one-off price level effect. They can look through it. The risk is that workers look at it and think, wait a second, I want a higher pay rise. And that obviously creates this persistent dynamic and makes it much harder to bring inflation back to target. But to answer your question, inflation tomorrow, 2.8%, we think. For the remainder of the year, moving up to 3%, above 3%, in fact, probably not quite as high as the bank thinks.
Yeah.
But on average, across the course of this year, we've got 3.1% for CPI, so not a comfortable picture for the Bank of England.
No, not at all. An uptick of inflation, basically the world, I think every central banker's worst nightmare at the moment. Hugh Gimber, global market strategist over at JP Morgan Asset Management. Of course, our very own Dan Hansen, Bloomberg's chief UK economist, walking us through some of the labor data out of the UK. Coming up on the program, we shift back to the earnings picture. BHP posting a big drop in first half profit on lower Chinese demand. We're going to dive into the details. This is Bloomberg. Iron ore gaining this morning after BHP CEO say he's seeing tentative signs of recovery in the Chinese housing market. Our very own Martin Ritchie is all over the story. Martin, walked us through these results.
CEO Mike Henry of BHP putting a rather brave face on results that were, of course, not entirely positive. 23% down for profits for BHP in its first 6 months. The big story here is really about iron ore. As you mentioned, their revenues falling from iron ore because of the lower prices in China as a result of China's slowdown and property crisis. Henry did, as I said, put a brave face on it, saying he's seeing green shoots in the property sector. But really, the reality is that this is a company that's in the middle of an adjustment as China's economy moves away from its breakneck industrialization and urbanization, and it's looking to move into areas like copper, which is important for the energy transition, and that's what will see from BHP this year if it does go ahead again with more acquisitions.
Certainly something we're going to be keeping a close eye on. BHP, no stranger to the M&A story. Bloomberg's Martin Ritchie walking us through that. We thank you so much. Coming up on the program, we're going to be speaking to the chairman of the world's largest aircraft crew maintenance and insurance provider on the outlook of the aviation industry. That conversation next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. These are your top stories. The United States and Russia beginning talks to end the war in Ukraine. Kyiv not taking part as Europe struggles to respond. Meanwhile, European bonds extending their slide on concern that governments are going to need to boost their debt sales to fund a bigger military. Plus, the pound pairs losses against the dollar after the UK pay growth and employment both rise, a sign of resilience ahead of the upcoming hikes in payroll taxes. Now let's go to the aviation sector, where at least 15 people have been injured after a Delta plane flipped and came to rest upside down after landing in Toronto. The plane flying in from Minneapolis had 76 passengers and 4 crew on board. According to local paramedic services, 3 passengers are in critical, non-life-threatening condition, while the other 12 sustained mild to moderate injuries. Now, just weeks after the Washington air crash, the worst U.S. civil aviation disaster in decades, the National Air Traffic Controllers Association say they're analyzing the fallout from a slew of firings. The union raising concerns over safety after hundreds of FAA employees were fired. And sticking with the United States, Southwest Airlines saying it will cut more than 1,700 jobs in its leadership ranks, impacting 15% of corporate positions. They're the first layoff in the U.S. carrier's history. Now, the cuts extend the upheaval that's gripped Southwest for much of the past year, including a battle with activist Elliott Investment Management, a board overhaul, and significant operational changes. Now, a lot going on in the aviation sector, as if we've just laid out. Let's get a little bit more context here. Boeing delivered more jets in a month than Airbus for the first time in almost 2 years. It all comes as the plane maker begins to recover from a lengthy strike and years of turmoil. For more on that outlook of the aviation industry, I'm joined now by Gediminas. I'm going to say this right. Gediminas, Ziemelis. I completely butchered that. I sincerely apologize, but we're grateful for having you. Chairman of Avia Solutions Group, the world's largest aircraft crew maintenance and insurance provider. You've recently placed an order for about 80 jets with Boeing. Walk us through that relationship.
We've been selecting from 2 OEMs 1.5 years, and outcome was that we did order with Boeing during the first week after the strike. So we were first order when we ended with the settlement with unions.
I mean, you can understand my skepticism here in that so many folks who are dealing with Boeing from a supply chain perspective, from a customer order perspective, are raising some eyebrows at that company turnaround. How are you thinking about it?
Aviation is very organized industry and it's very supervised. I mean, we understand what causes manufacturer to pass this stage, and then level of documentation which we should present to the authorities, steps and turnarounds which we should execute in the organization. Currently, we believe that Boeing product is very safe. We believe that by 2030, when our deliveries should start, we will be on time and we would catch the production line, because we're talking about 14,000 suppliers involved in all supply chain, and Boeing is just the final stage. So we participating in that ecosystem, we see things, and we also understand that aviation is very cyclical. If we have some interruption or some disruption somewhere, after a couple of days and hours, you will see some bigger disruption. Example with the flight. If you have a delay in the morning, 1 hour, in the evening, that aircraft would delay 4 or 5 hours.
Yeah. Absolutely. So a snowball effect, if you will. You talk about the cyclical nature of the aviation sector. We were just talking about so many sort of layoffs happening in the United States right now, these cost-cutting measures that are happening amid a backdrop of consolidation that's also really kind of been stamped upon. How are you viewing the longevity of that story, that pickup that we're looking for in the airline sector? Are you seeing any elements of it?
You know, at the end of the day, aviation and air traffic is driven by producers of aircraft. They are driver of everything. I mean, last 5 years, we didn't see any significant startups in the global scheduled airline business because of lack of supply. 2016, 2019, especially in emerging markets, we saw 5+ sizable startups, and we were feeded with the brand new aircraft. We placed biggest orders, and they became sizable participants of the scheduled market in the emerging markets. I think consolidation is happening where there is no opportunity for the organic growth, and lack of the new aircraft. 3,400 aircraft still unsubstituted. They extended the maintenance programs because Boeing and Airbus was not producing enough aircraft last 5 years. So yes, I do see consolidation, and the competition councils very precise, especially in Europe, and they will not allow, my opinion, several potential transactions because it's coming risky to the passengers. At the same time, we will not see any major startups in the market because of the not enough aircraft. So we will see interesting situation next upcoming 4 or 5 years, and everybody predicts that 2030 we will have new page in aviation ecosystem.
You mentioned this kind of manufacturing almost trough that we've seen that has led to this need for consolidation. Do you think that's behind us, or do you think there's more pain in that manufacturing facet coming up?
No, I mean, again, we should always talk about the same. 14,000 suppliers participate in this ecosystem. And if somebody not producing something, it hurts all system. So nothing new. It's very certified driven, very supervised driven industry, and innovation, nothing is happening fast. If somebody wants to produce something new, it takes decades to enter to the market and to pass all the certification processes.
Where do you think the cost pressures are coming from, though? Now that we're looking at it, where are the cost pressures coming from? Where are the demand actually coming from as well?
Demand is driven by GDP everywhere. And if we compare best developed countries and lowest developed countries by the traffic, the difference is 10 times. So in the world today we have 4.8 billion passengers per 2024, with the population less than 1.8. So it's a 0.6 passenger per capita. So if we look to USA, we have 3 passengers per capita. If we look to the Europe, it's 2.8 passengers per capita. But if you look to the India, it's 0.1, 0.2 passenger per capita. So countries are developed very different. And a lot of opportunities when it comes continent by continent, country by country. Innovation, again, it's very much driven by GDP. People want to travel. People want to go to the holidays. Businesses traveling. Of course, we have some alternatives, especially after the COVID, a lot of solutions, but still, business travel. So we're talking that mobility of the population will not disappear. It's driven by GDP.
We should remind our global audience that you operate a leasing company that, of course, has these relationships and this kind of view on the world. Walk us through your maybe projections for leasing costs in the year, 2 years.
Our leasing is special because we're providing everything in. Our crew, our maintenance, our insurance, and we effectively currently are 11 airline companies. So we're providing capacity to the other carriers, and we're leveraging the seasonality demands peaks. So all European narrow-bodies airline companies losing money in wintertime. All. Because people go for holidays in summer. So all of these companies have excess capacity in wintertime, around 40%.
Yeah.
And some of them ground aircraft, some of them ground for long maintenance, some of them fly and losing money. And if somebody is tracking publicly listed airline companies and will track quarter by quarter, we will see those losses. So effectively, it causes more expensive ticket for the passenger in summertime in European continent. Our goal is to to help to leverage summer winter capacity, to provide summer capacity only to European carriers, and to place our aircraft in counter-cyclical continents which has opposite seasonality, Asia-Pacific, Latin America.
Yeah.
And at the end of the day, all these companies from all these 6 continents has right to get cheaper tickets, because competition will become more complicated for everybody since 2030, and airline companies should prepare to find the ways to increase their efficiency. And managing different capacity, summer and winter, is one of the potential goals, which was never ever happened by big scale before the COVID.
Fascinating conversation. We will have to see how that all unfolds. Thank you so much. Of course, I'm going to say this right. I'm so sorry. Gediminas Ziemelis, chairman of Avia Solutions Group, joining the program to talk a little bit about the aviation sector. In the meantime, as we were speaking to him, getting some headlines crossing the Bloomberg terminal, it looks like Thames Water is restructuring, and that plan has now been sanctioned by the UK High Court. A London judge approving that crucial rescue loan for Thames Water, giving the utility some much-needed breathing room while it continues to negotiate restructuring with its lenders. The plan could see as much as £3 billion loaned by a number of Thames' existing senior creditors. It urgently needs cash as it faces debt maturities and other payments, with the company saying it could run out of money by late March. Of course, a crucial UK story we've got our eye on. Another one crossing our terminal as we speak. Some lines coming here from BOE Governor Andrew Bailey talking about, well, I think we already kind of know, which is that they are facing a weak growth environment in the UK. They're saying it's hard to know if it's supply-driven or both a supply and demand-driven weakening. But the hump in inflation is due to administered prices. We were just talking to Dan Hansen, our senior UK economist there, about how 3% inflation, an uptick in those inflationary numbers, is indeed on the agenda. But the risks are on two sides, and ultimately saying that disinflation is gradual, despite, by the way, having a 2.8% forecast going into tomorrow's CPI. We're going to dive into all of that. We also have one eye on what's going on in Germany. Coming up, we dive into that angle. Europe's security weighing on the country ahead of this weekend's vote. We're going to dive into the German election, European defense, and much, much more. Stick with us. This is Bloomberg.
This Sunday, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in Sunday, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything.
The Ukraine war looming large over the German election campaign as Europe's biggest economy heads to the polls on Sunday. Defense policy becoming a key dividing line between current Chancellor Olaf Scholz and frontrunner Friedrich Merz of the CDU. Let's bring in our very own Oliver Crook, our correspondent over in Berlin. Ollie, walk us through the differences between both candidates.
Yeah, so for both candidates, you can both call sort of one a little bit more dovish and the other a little bit more hawkish on sort of not just the question of defense, but also the question of fiscal. And that's sort of a sort of push and pull, I should say, on defense policy. Because Olaf Scholz on the one hand, and we should begin by saying that they're both very supportive of Ukraine. They're both big Europeanists sort of at their core. But Olaf Scholz has been more resistant to send some of the more aggressive military equipment. You know, he was really dragging his feet, really wanted to follow the United States. After the United States agreed to send tanks, for example, then Germany would follow, and then they never followed with the long-range missiles, as Olaf Scholz never wanted to send those Taurus missiles over. On the other hand, he was much more dovish on the fiscal side, saying basically that the debt brake in Germany needs reform, setting up special funding in order to pay for military budgets, and really being okay with working around that constitutional debt brake that limits German borrowing. On the other hand, you have Friedrich Merz, the likely next chancellor of Germany, leading the polls right now, head of the CDU, who has been advocating for a long time a more aggressive policy policy in terms of weapon delivery to support Ukraine, while on the other wanting to stick to the debt brake and potentially it being more difficult to come up with the money required in order to build that defense spending. That being said, Critty, there's another point to make here, that the biggest job opening in Europe right now is not the Chancellor of Germany, it is the leader of Europe, right? That is not a formal position, but what we've been seeing is their sort of leadership vacuum within the European sort of system, and really a big problem when it comes to dealing with Donald Trump. Obviously, the Chancellor of Germany has huge sway within political affairs in Europe more broadly. Olaf Scholz has not really been a very sort of outspoken leadership figure within Europe, despite the fact that he's occupied that position. Is this an opportunity for a reset for Friedrich Merz to come in with a relatively strong mandate, if he can muster one on Sunday from this election, and come in and basically try to reset that relationship and be that person in Europe? That is something that we'll have to see of whether or not Friedrich Merz has the sort of capacity to grasp that opportunity.
And so much of that conversation really focusing on, of course, as we talked about this Ukraine piece, the defense story. What about the U.S. administration, the tariff overhang, not to mention their thoughts on who should be leading Germany?
Yeah, so what's really interesting here, Critty, is seeing the kind of U.S. involvement in European affairs. It is obvious that the sort of America First Trump policy has been one that is very focused on rebalancing the economic relationship, rebalancing the trade relationship, closing that trade gap that exists between the U.S. and Europe, which is about $250 billion. That is what he wants to see narrowed down. But increasingly, as we saw from J.D. Vance over the weekend giving that speech in Munich, it was not so much about sort of rebalancing and sort of extracting economic balance between Europe and the United States. This was a speech that was really about exporting the sort of MAGA ideology from the United States to domestic politics within Europe, basically calling the biggest threat to the European continent, not from Russia, not from China, but the threat from within, which he was sort of implying were the mainstream democratic parties who were ignoring more of the populist voices and basically what he's saying of working against free speech. He met with Alice Weidel, who is the leader of the far-right party here in Germany, the Alternative for Deutschland, which is expected to come into second place. But it's interesting to see the sort of focus of the Trump administration shifting not just to the economics, but the internal domestic politics within Europe, and how that could create potential fragmentation, yes, within Germany, but also the broader European landscape. We know the Hungarians, for example, and Orban's party has been very supportive of Donald Trump, even in the sort of campaign mode. Could we see that sort of be a wedge that is driven further within the EU? It's certainly a conversation that will be continuing as Europe tries to scramble to try to respond in a unified way to this Trump administration.
Bloomberg's Oliver Crook joining us in Berlin as the countdown to the German election is certainly upon us. We thank you so much. Sticking with that same theme, European bonds slipping, defense names on the stage, an incredible rally on the likelihood of that greater military spend. Bloomberg's Valerie Titel is all over that story. Val, put that rally into context for us.
Well, Critty, one that really hit home for me is that defense names in Europe have rallied more than the Mag 7 since the U.S. election. Think about that one for a bit. But year to date, the defense sector in Europe is up 22%. One of the standout performers has been Rheinmetall. If you take today's rally in combination with yesterday's surge, we're up nearly 55% year to date. So positive read-through for European stocks on this extra defense spending. A bit of a negative read-through when it comes to European bonds, though. This extra defense spending will probably be likely to be financed by more debt issuance from European nations. We're seeing yields tick higher today across European government bonds. But, Critty, it's not been that drastic of a yield rise. I think the expectation out there is any increased spending will be taken down by the market. We had quite a few European bond syndications that showed record demand. So there is demand for European paper out there. Lastly, let's check on the U.S. pre-market names. I want to check on those U.S. defense market names. They have been grabbing some of the European defense rally. Lockheed Martin up some 1.5%, RTX up 1.7%. So there is some positive read-through into the U.S. defense sector.
Certainly something we're going to see if it does indeed hold. Bloomberg's Valerie Titel walking us through those market dynamics. We thank you so much. Coming up, we are going to talk about Elon Musk saying that the latest version of his xAI startup is, quote, one of the smartest AI on Earth. Do those claims measure up? We're going to dive into the details next. This is Bloomberg. Elon Musk's artificial intelligence startup xAI has showed off its updated Grok 3 model, a technology that the billionaire says is the, quote, smartest AI on Earth. Matt Bloxham from Bloomberg Intelligence joins me now. Matt, how big of a moment is this for the AI space?
I mean, it's a significant step forward. I wouldn't say it's, the kind of defining moment. That's my sense so far is that, probably the DeepSeek announcement was a bigger moment in the AI. I mean, this Grok 3 model's been under development for quite some time. It's actually a bit delayed. It was meant to come out last year. So, I mean, clearly from the demonstration they gave a few hours ago, it's definitely performing better than some of the existing models across the kind of main benchmarks they use against maths and coding, things like that. But maybe not significantly ahead. And obviously, we do know that people like ChatGPT have evolutions of their model coming out, same with Meta, inevitably with Google too. So even if this is the best performing model out there, as Elon Musk says, it may not be the best performing model for too long.
We're seeing a lot of the tech stocks around the world take their lead, not from the United States, but from China. A lot of this comes from the Xi almost stamp of approval on the tech sector. To what extent is that the driver of markets here in Europe, here in the United States?
Yeah, I mean, I think after such a long period of lull for the China tech sector, which has really taken off recently, you've seen this transfer of value, $1 trillion off the Western tech stocks and it pretty much into the China tech stocks. I think it's clear that China's always been innovative on tech. Historically, they've perhaps kind of copied Western developments, and I think to some degree they're still doing that, but they're clearly incredibly smart people, huge amounts of talent there, and they're taking the technology that they can get their hands on and really innovating. So yeah, I think the US is on much higher alert than perhaps it had been about the developments of China in technology and responding appropriately to that.
It's fascinating. We'll see, of course, if this actually sticks. We've been talking about for the last couple of hours whether or not we actually see this idea of this kind of buy it from China equivalent to the buy in Europe on just suppressed valuation concerns, getting a stamp of approval from the governments. Matt Bloxham from Bloomberg Intelligence walking us through that story. It is, of course, pre-market trading kicking off over in the States. Intel and Broadcom catching a little bit of a bid off of some reports earlier in the last couple of days, basically, that they may be talking about doing some deals with TSMC that would break the U.S. chip-making giant into two. We'll see if that does indeed continue. Intel shares getting a big boost pre-market, higher by 4.6%. Broadcom stronger by 0.3%. We're going to keep you apprised of all the markets as we count down to the U.S. trading session. They are getting their week started after the President's Day holiday in yesterday's trade, or lack thereof, I should say. Up next, Bloomberg Brief. Danny Berger and Manus Craney take it from here out of New York. Stick with us. This is Bloomberg.